we're diving deep into the Washington State Commercial Real Estate Market Report for November 2025. And the story here is really about fighting on three fronts at once.
It really is. You had a massive federal shutdown, you had these aggressive new tariffs, and, still those lingering labor disputes, a real triple threat environment.
Right. But the market didn't just collapse, it's more complicated.
It's fracturing. The report calls this period one of stark contrasts. And I think this is the key phrase, an asymmetric recovery.
Meaning performance is just wildly different depending on the sector.
Exactly. You have to be incredibly precise to see where the pain is and, more importantly, where the opportunity might be.
Okay, so let's start with the chaos from that federal shutdown. Beyond the obvious freeze, what was the most damaging effect?
It had to be the data blackout. It's toxic for investors.
Because key sources went dark.
Completely. The BLS, the BEA, they suspended their data releases. So if you're trying to underwrite a deal, you can't verify local employment, you can't check inflation data, you're sort of flying blind.
And that paralysis extended to administrative approvals, too.
Precisely. That's the other shoe that drops. Stalled reviews for things like EPA statements or even LIHTC forms.
Those are the low-income housing tax credit forms.
Right. It all means project starts are getting pushed deep into 2026. This administrative friction just accelerates future supply shortages.
And on top of that, you add trade friction. The Liberation Day tariffs are projected to cost the state, about $2.2 billion?
Over 4 years, yeah. And you can see how that manifests directly in real estate through one key metric, port volume contraction.
So fewer goods moving.
A lot fewer. The Northwest Seaport Alliance, they recorded a 14.4% year-over-year decline in container volumes. And that isn't just a number on a page.
No, that's the direct reason industrial demand is softening.
It is. If fewer containers are coming in, you need less transloading space to move goods to trucks. That leads directly to rising vacancy in places like the Kent Valley.
The labor situation is also a fascinating contradiction. The Boeing IAM strike ended, which should have been a good thing.
And it was, for a moment. It injected some immediate liquidity from ratification bonuses. But that consumer bump was immediately tempered.
By the layoffs.
Yep. The strike ends, and then Boeing announces a 10% global workforce reduction. WARN notices confirmed about 2,200 layoffs in Washington for early 26. So you get a short-term boost, followed by this really severe localized risk for housing and office space in places like Renton and Everett.
Okay, let's zero in on the sharpest contrast in the report, the office market. This is the painful correction we all keep talking about.
And the difference between geographies is staggering. The Seattle CBD is suffering. We're talking a historic high vacancy rate of 35.1%.
And a big part of that is this sublease burn-off phenomenon.
It is. All that space that tenants put on the shadow market is now finally converting back to direct vacancy. The problem is now officially back with the landlord, and that is pure financial stress.
But you cross the bridge to the east side, and it's a completely different picture.
Much more stable. It's holding at around a 21.2% vacancy. That resilience is partly fueled by big tech RTO mandates, but the real protection is supply.
There isn't any.
Zero. There's no new general office construction underway. That guarantees a future supply freeze, which really protect those east side assets.
And that tariff drag we mentioned, it also hit the industrial market hard, a major reversal there.
It did. Linking right back to those falling port volumes, the Puget Sound industrial market recorded negative net absorption for the first time in almost a decade.
More space was vacated than leased.
Exactly. But construction starts are down 53%. So while that's a problem now, it's actually setting the stage for a potential supply shortage in 2027 or 2028 if global trade recovers.
So the real defensive stronghold seems to be multifamily.
It is. And it's all because of what the report calls the supply cliff.
Yeah.
Units under construction dropped a massive 36% year over year.
Which just guarantees future scarcity.
It does. With demand staying pretty steady, that means you can project some really strong rent growth coming in late 2026. It's the beacon for capital right now.
And then there's retail, which showed this unexpected vibrancy. Downtown Seattle foot traffic hit 105% of pre-pandemic levels. How?
Pragmatic policy reform, actually. The city passed legislation that exempts small commercial spaces under 7,000 square feet from some hugely prohibitive code requirements.
Things designed for massive retail boxes.
Right, like elevator upgrades. That one change just drastically lowered the barrier to entry, and it allowed local entrepreneurs to activate all those vacant storefronts really quickly.
So what does all this mean for you, the prepared investor?
The whole strategy for 2026 is managing that asymmetric recovery. Transaction volume is slowly returning. You see it in high-profile deals like the Walton Loft sale.
Over $500,000 a door.
Over $555,000 per unit. That price signals real surgical confidence. Institutional capital is being selective, but they absolutely believe in the long-term value of prime Seattle assets.
The central risk, then, remains the buy. The commoditization of all that Class B office space in the CBD. If these aging towers just can't be converted to residential, what happens? Do you think the policy reform that worked for small retail could ever be applied to massive office towers to save the downtown core? That's the billion-dollar question for the next cycle.